Last month, we talked about building your retirement paycheck, and today we're doing something a little less fun, but every bit as important. We're talking about how do we protect the plan? How do we make sure we don't have any potholes? And so these are some of those insurance decisions that you make in your last few working years, and a couple of them you'll only make once. I want you to walk out of here knowing which ones those are and what questions to ask before you decide. With a quick disclaimer, I don't sell insurance, but insurance is an incredibly important part of my clients' plans and making sure they're protected. We'll get into another fun, quick disclaimer here. Everything today is educational, not advice for your specific situation. Any dollar amounts I show or concepts I illustrate, those are hypothetical in nature, but are very representative of what I see in practice. All right, so we will get into it. So when we think about insurance, a lot of folks start off with traditional insurance, but as a Washington public employee, really one of the most important insurance options and decisions you have to make is in regards to your survivor option benefit when you go to retire. It's part of your paperwork, or if you're filling out the retirement application online, it's a little checkbox you check, and we want to make sure we give that decision the care it needs. And so you might be thinking, well, Seth, this is an insurance presentation. Why are we even talking about this? The reason we want to talk about your survivor decision as a public employee is it really can substantially impact your spouse. I've seen multiple times where single life option was chosen. Most often it's the husband. The husband passed away and the wife's income went substantially down. And so if that's an option you go, we want to make sure you're protected. So this is where we start. It's incredibly important that we start here, especially as public employees. If we get it wrong in one direction, we gave up income for a spouse who maybe didn't need it. If we get it wrong in another, you leave that person you love short for the rest of their life. And here's one of the challenging parts of that. You make this choice once. Usually it's in the busy weeks right before you retire when you're ready to be done, and then it's locked in place. That's why I want to slow it down today and give it the time it deserves. And then we'll talk some more about some of the traditional insurance things or insurance components of making sure you're protected. So 4 things today. We're going to get into pension survivor election. We're going to spend some time here. Second will be life insurance and thinking about whether you still need it and how that changes as you get later in your career. Third will be long-term care. And then fourth, we'll be talking about additional liability coverage. But let's go ahead and get started with the pension. Okay, and your survivor decision. So first thing, from a definition standpoint, I want to make sure we're clear. A survivor and a beneficiary, a lot of times they're the same person, but they are not the same thing from a definition standpoint. I want to make sure we understand that. So a survivor is the person you name that keeps getting that monthly pension check for the rest of their life after you pass. When you name a survivor, it does, and you pick a survivor option, it does lower your own check, and we'll talk some more about why that is. However, they essentially get to continue a portion of your pension after you pass away. So a beneficiary is a little bit different. A beneficiary just gets essentially a one-time payout of whatever money is still sitting in your contribution account. And what often surprises a lot of folks is what you've actually put into your PERS to left to, if you're on the state patrol plan, whatever plan you're on, that balance oftentimes can get zeroed out very quickly. However, depending on which plan you're in, and whether you're vested or not, how many years of service, whether, let's say you were to pass away while still working, your beneficiary or your survivor, they may still get a payout of essentially a reduced pension versus just a lump sum. They also have a choice of a lump sum. So it's important to understand that decision looks differently during your working years versus when you retire. So primarily a beneficiary is in place while you're working. A survivor comes in place once you retire. Okay. And the other kind of key decision with this is you are on a little bit of a clock. So 90 days after your first pension payment, once you do retire, that survivor choice is basically permanent. There are some exceptions, but that's a key number to be aware of. All right, let's go on to the next slide. Sometimes I'm technically challenged. All right, so watching in our DRS pension systems, we have four options, and they're the same regardless of whether you're PERS 2, left 2, PSERS, TERS, SERS, all the plans. So they're all the same. These are the four options you have, and there are a number of factors that you want to be thinking about with each of these. So option one is single life. Pays the biggest monthly check of the four, but it pays only while you're alive. When you die, the pension dies and it goes away. So that can have a really dramatic impact on the income of a spouse, a partner, or someone else relying on that pension income. So it's incredibly important that if you do go the single life option, that you think about what is the consequence to anyone that's potentially depending on my income. Now, if you have a spouse that has also saved very well, you have ample savings in retirement, maybe it's not a big deal. Or maybe there's a large age gap between you're substantially older than your spouse. That can potentially lead to a large reduction in your pension if we choose one of the other three options. So let's go ahead and jump into option two. So with the 100% survivor option, your survivor keeps the same monthly amount you are getting for life, but it has the biggest reduction. Option three cuts that in half for your survivor, so it's going to be 50%. And then option four is a middle version, where the 2/3 version, so it's right in the middle. Again, the exact dollar amount from a reduction standpoint depends on which of these options you choose, as well as what's the age difference. And I do want to circle back to the question popped up in the chat. I want to make sure I address it now as we're going. So there's a question is what happens if you die before you retire and have the opportunity to select a survivor option? So that is going to depend on how many years of service you have in your pension system. So and this is going to be dependent upon each system. I don't have them all memorized. However, for PERS 2, I do have that one memorized. And this is where things are a little confusing. Again, check your plan benefit, go out to DRS, and it'll say specifically what your options are. But for PERS 2 in particular, once you have 10 years of service, so note, that's not the 5 years vesting, that's 10 years of service, not vesting. You then, your survivor would then be eligible for a pension benefit. It's going to be substantially reduced if you pass away, unfortunately, well before you retire. But they do, once you get to 10 years, your survivor will then get a lifetime benefit. However, if you pass away before 10 years for PERS 2, your survivor will just get a lump sum. They'll get whatever you've put in plus interest. So that's a key component to keep in mind. If we pass away while we're working, our survivor or our spouse or beneficiary will be dramatically impacted. In terms of figuring out the reduction, it's ultimately going to depend on that age reduction, or what does the age difference look like between you and your spouse. If you're retiring early, your pension amount is also going to be reduced. Again, that's going to be plan specific. And then we have just whatever your normal pension calculation is. So years of service, average final compensation, definitions vary slightly between plans, but let's say for PERS 2, that's the one I'm going to use, and it would then be 2%. You have your base pension calculation, and then it's reduced by a combination of which of these four survivor options you pick, plus the age of your survivor. Okay, so let's continue on. So let's go ahead, and the trade-off between these two, if we're choosing one of these options other than 100%, I'll make sure I hit any questions I did not in the chat as we get through the rest of the materials. So options 2, 3, 4, those all shrink your monthly check while you're alive. In exchange, keep income flowing to your spouse after you're gone. And I'm gonna look at some actual numbers here. All right. So let's make this a little more concrete. These are numbers that I've just run hypothetical scenarios, but it is fairly representative of what I see in real life. So let's say our single life selection would pay us $5,000 a month, and then our survivor would get nothing. But if we were to pick the 100% survivor option, our check might drop to $4,400 a month, but our spouse gets to keep that $4,400. You pick half the survivor, the cut is smaller, maybe $4,650, but your spouse only gets half down the road, about $2,325. And look at that third row, because this is one that people often over. A two-thirds option lands right in the middle. You keep something like 4560, your spouse would get a little over 3,000 a month for life. Some folks end up here. However, in reality and in practice, what I see with clients is this decision really comes down to, are we going to do 100% survivor or are we going to do single life? Now, I'm not saying that's rules of thumb. Everybody's different. Situations are different, but a majority of the situations I encounter, that is the decision. We're essentially choosing 100% survivor option, or we're looking at single life and figuring out an insurance solution. So keep that in mind. But at the end of the day, as you get to retirement and you're making this decision, you want to actually map out what these numbers look like for you. And DRS will give you estimates as part of your official benefit estimate, as well as using the estimate tool on their website to help you understand what those numbers are. So, okay, let's go ahead and move on. So, a few fine print things that I want to make sure I cover. So, first, the pop-up, and hopefully this answers your question, Tiffany. So first, the pop-up, and it is what I like to call it. If you picked a survivor option, let's say we're doing 100% survivor option and your spouse passes away, you're not stuck with that reduced check forever. You have to call DRS. It doesn't automatically happen. DRS doesn't know that your survivor passed away, but you call DRS and say, hey, my survivor passed away, and they'll increase your benefit up to that full single life amount. A lot of folks don't know that to make that call, and they leave money on the table for years. The great thing about Washington is sometimes with that pop-up option for other states, they actually have a reduction as part of the initial pension calculation to add the pop-up. However, in Washington, it just automatically happens. It's not part of an additional decision you have to make. So, second, spousal consent. If you want to take single life, or if you want to name someone other than your husband or wife, your spouse has to agree in writing, and it has to be notarized. Washington doesn't want a spouse to have that happen without them knowing. So that's really important to keep in mind. And then third, we've chatted on this a little bit. You get 90 days from your first check to make an adjustment. After that, it's locked unless your survivor passes, you divorce, or remarry in retirement. Those are some of the common exceptions. That 90 days can go fast, so we want to make sure we get that right. Okay, so I do want to touch a little more on that single life option and potentially getting a sales pitch from someone selling insurance where take the single life, and basically it's called a pension max strategy, where you take the single life and then you essentially purchase insurance to replace what that pension's worth. So this can be an option for some folks, and it mathematically can make sense. However, what I want to highlight here is the base calculation of whether the math makes sense on this or not is the reduction from your survivorship option, from 100% survivorship. Is that greater than or is it less than the insurance premiums you would be paying? If that pension reduction is greater than what you would be paying in insurance, then you're going to come out ahead, because if you do an insurance option, if the policies are structured properly, you're going to come out ahead. So if the pension reduction is greater than the premiums you would be paying on insurance, then this potentially makes sense. However, you do want to think about what is the complexity associated with that. Oftentimes, when I'm doing this with someone, we're doing a term life ladder, we're doing multiple policies, and then we're doing a modest whole life policy. So there's multiple policies. It's relatively complex. And so those are all things you want to keep in mind as you're thinking about this pension max strategy and whether it potentially makes sense for you and your family. It's something for every client that I run the numbers on, look at whether it makes sense or it doesn't, and then we go from there. And that's the key with this, as well as what are your personal preferences in terms of complexity. So I'm not against life insurance at all. I'm just against trusting your spouse's income to a sales pitch without doing the math first. And it's important to compare those numbers. So, all right, let's move. So we've talked a lot. We've spent a lot of time talking about that survivor option because it's really one of the most important insurance decisions that you'll make. but some folks don't think about as insurance. However, it is incredibly important that we lump that into the insurance conversation. So now I want to move on to some of our other more traditional insurances. I'm not going to touch on every single type of insurance. I'm just going to hit on some of the key ones. And I want to start with life insurance. Think back to when you bought that. If you're later in your career, you probably bought that earlier in your career to replace a paycheck while your kids were young, the mortgage was big. And if something happened to you back then, it left a real financial hole, and insurance filled that. Now, as you get later in your career, if you fast forward to now, that mortgage is almost paid off. Kids are grown and out of the house, and between your pension and what you've got saved, your spouse might be okay, or maybe there's a much smaller hole that we have to fill. Now, I'm not saying go cancel everything automatically in your last few working years, but what I do encourage people to look at is, especially as they get later in their career, is the insurance we have right now appropriate for us? And so this is where people start actually doing this. This is a spot where a lot of people got sold expensive permanent policies that they don't need, dressed up as an investment. I like to say insurance is not an investment. An investment is an investment, and insurance is insurance. Let's keep those two things separate. So we want to be careful there. Generally speaking, term insurance is what I generally lean towards, and it's what most folks need. However, there are situations where a permanent or whole life policy can make sense, but those don't happen nearly as often. Okay, we're going to move on to long-term care. It's not always the most fun thing to think about, but it's incredibly important to know your options, know what the costs are, and have a plan in place. And hopefully we've got the theme here that I'm big into planning before we make a decision on anything, whether it's insurance, survivor, investments, taxes, doesn't matter. We want to have a plan in place for these different situations. So long-term care is to help with everyday things, also known as activities of daily living is a more technical definition. These include things such as bathing, dressing, getting around. And when age or illness catches up, that can happen. And the odds are not small. About 7 in 10 people who make it to 65 will need some form of long-term care. Now, what I do want to emphasize before we look at what those numbers are of long-term care is that the severity of a long-term care event can vary dramatically. There are situations where someone has an extensive long-term care event where we're paying up to that $13,000 a month number for 4 or 5 years. However, there are most often it's a situation where folks are in long-term care for a much shorter duration of time. However, that doesn't mean we don't want to prepare for a worst case scenario. So the other component of thinking about long-term care that I want to make sure I emphasize is that Medicare does not pay for long-term care. A lot of folks assume it does. It doesn't. And then I want to get into that cost. In Washington, assisted living runs around $7,600 a month. It's going to vary widely based on where you're at in terms of your location. And nursing home is closer to $13,000 a month. That can be a hard number for a lot of folks to cover without a plan. So let's talk about that plan. All right, I want to hit on Washington Cares. Should be part of anyone's analysis unless you opted out and bought an additional private policy. But for a lot of folks, we've seen Washington Cares deductions come out of their paycheck for a few years now. And so what you're doing is you're paying 5/8 or 58 hundredths of a % of your wages while you're working, and the day you retire, you stop paying. The full benefit on that is 36,500. It's going to be inflation adjusted. So it's a benefit that can get you started. One of the other things before we get into how much of that benefit covers is qualifying for that Washington Cares long-term care. The first and eventually will be the most common is called the permanent pathway. You contribute to it for at least 10 years. You've got lifetime access to that full benefit. It's the one most folks have. We also have a couple of temporary or transition pathways. Contribute 3 of the last 6 years. At the time you apply, you get that full amount without the 10 years. It's called temporary for a reason. It's to help some of that transition period. And then the transition pathway. If you were born before January 1st, 1968, you earn 10% of the benefit, about $36.50 for every year you contribute, and that piece is yours for life. Okay, so here's the part that I think really matters when you come to thinking about your own timeline. Contributions start in July of 2023. If you try around 2030, you have 7 years in, not 10. And so that temporary pathway. So you'll need to factor in that reduction benefit. For an early retiree, it really comes down to whether you reach those 10 years before you walk out the door or whether you were born before 68. The other thing I want to emphasize here is in terms of meeting the requirements and qualifying for benefits is if you're having a long-term care event, the odds of you being able to apply for this by yourself are probably not great because you're going to need help with those daily standards of living, at least three of them, things like bathing, eating, mobility, managing medications. And so you want to make sure you have someone that can work and help you apply for those benefits. So that gets into a whole estate planning conversation too, but that is something I wanted to emphasize here. And then lastly, keep the size of that benefit in perspective. That's at $36,500 a month. That's going to cover about 5 months in an assisted living facility here in Washington. That's a small start and can cover some situations, but if we think about the severity of long-term care events that can happen, that can be used very quickly. All right. So 3 ways folks typically pay for long-term care. We have self-funding, we have a traditional or hybrid insurance policy, and then home equity. Now, the key thing I want to emphasize here is that we're doing the work and the analysis, looking at our income streams before we jump to an insurance option. Your house is oftentimes a key piece that needs to be included in that analysis. And whether you're married, someone's depending on, someone's going to live in that house, those are all things you want to think about. And then from a self-funding standpoint, that's also something you have to think about. And the last component of that before you eventually get into an insurance policy is if you're self-funding with pre-tax or ordinary income funds, such as a pension, traditional deferred comp savings, you're going to be able to use that money very tax efficiently to pay for that long-term care. So want to keep that in mind. Now, on insurance policy, lots of the traditional policies, they're hard to find, they're pricier. Most often we lean towards a hybrid policy that combines life insurance with long-term care. All right, let's jump to that last key piece of insurance that I want to talk about, and that's called umbrella liability insurance. And a lot of folks skip this. So I want you to take a second. Imagine you're in a bad car accident. It's ultimately your fault and you get sued. And that judgment comes in above your auto insurance limit. Without more coverage, folks can come after a lot. Now, there are some protections with your retirement savings, such as deferred comp. However, as well as things like your home too, there's some protections in place for that. But an umbrella policy is a really important component to add, especially in retirement, because or as you get close to retirement, because you don't have all those years to work and to potentially make up for some situation such as a lawsuit from a car wreck that you may have had. So what an umbrella policy does is it sits on top of your home and auto insurance and it catches any of those big claims that blow past your regular limits. There are typically minimum limits on those auto and homeowners insurance policies that you have to have in place before you can buy umbrella policies. So you want to keep that in mind, but it's typically relatively cheap. So for example, for $1 million of coverage, most people pay somewhere around $200 to $400 a year. It's going to really be dependent on a lot of different factors, but it's something to keep in mind that it's relatively cheap protection. So general rule of thumb on umbrella insurance, you want to at least cover as much coverage as you're worth. So one bad day can't reach that nest egg. All right. So let's start bringing it home here. So 4 things to protect. First, that pension survivor election, permanent and real. Make sure you take your time to get it right. Second, check your life insurance. Make sure it still fits your life. Life changes. Your insurance needs change too. Third, have a long-term care plan and make sure you're doing that full analysis and not making a fear-based decision. We want to make educated and informed decisions. If you are ever in a situation where you feel like you're being pressured into something, take a step back, run the numbers, talk to a professional that maybe doesn't have any skin in the game, and figure out what's best for you and your family. And then umbrella policy. A lot of folks don't have these. Make sure you have it saying it sits above your auto and homeowners insurance. Make sure you look into that and once you get those four right, your plan is built and it's a lot harder to knock down. I didn't cover disability insurance because our focus was on as you get closer to retirement, what needs are there. For a lot of public employees, you're going to have disability insurance built into your employer paid benefits. Sometimes it makes sense to add a little extra disability, but for most folks on disability side, just utilizing whatever is through your employer is sufficient. All right. So that's all I've got today. If you've gotten value today and you want to talk more in depth, I offer a free 30-minute conversation, retirement clarity assessment to help folks think about retirement, or even if you're not close to retirement, that helps, whether it's insurance, estate planning, taxes, investments, something I offer to folks to help us get to know one another. So never any pressure, no pitch.